Hello class and welcome to this final video on accounting for income taxes. We just got a couple more things to go through. We need to talk about when there's multiple temporary differences, how we should do that, and then a little thing called net operating losses. But just as a quick review, our four-step process here, our first step is to find our income taxes payable. To do that, we start with our pre-tax income, add or subtract out any permanent differences. If you remember, permanent differences are those that never reverse because of differences between GAAP and tax law. Then add or subtract our temporary differences, which are those differences between GAAP and tax law. That is not a matter of if they will get taxed, only when, so it is a timing issue. To get our taxable income, we multiply our taxable income times our tax rate to get income tax payable. The second step is to find our ending FTA and FBA. That stands for future taxable amounts and future deductible amounts. Future taxable amounts are amounts that lower our taxable income, make net income to taxable income go lower, and they create deferred tax liabilities. Future deductible amounts make taxable income increase. They create deferred tax assets. So once we find our ending taxable amounts and deductible amounts, we multiply that by the tax rate to get our ending deferred tax liabilities and deferred tax assets. Third step is to take that ending number, plug it into the T account as the ending balance, and analyze it and see if it needs an adjusting entry. If so, that is the entry you will make in your journal. And the fourth step is to plug income tax expense. I went through multiple problems on those on the deferred tax liabilities and deferred tax assets video, so go back and review them. You need to review this process, but we're going to do it one more time with multiple future deductible and future taxable amounts. The key here with these to remember is you can combine all taxable amounts and all deductible amounts, but you cannot mix the two. Okay, so I have an example problem here. We have pre-tax income of $80,000, and we are given the following temporary differences. Okay, we have depreciation, prepaid expenses, and then warranty expense. So we need to either add or subtract each of these to our taxable income, or from our pre-tax income to get our taxable income. Okay, our depreciation, there's a pre-tax difference of there is a temporary difference of $60,000, and that is because of market depreciation. So the tax depreciation is more than the book depreciation. Depreciation, so it's going to lower our taxable income. If it lowers our taxable income, it creates a future taxable amount because our income will increase in the future to pay for that, equals a deferred tax liability. Okay. Prepaid expenses. On the same thing, we do not expense them on our income statement, but since we paid the cash, we are going to expense them on taxes. So it's going to lower our taxable income, and our amount given for that was $17,000. I'll put this on here. Should have wrote all the amounts up there first. But it's $17,000, and it is also subtracted out as a future taxable amount, which equals a deferred tax liability. And finally, our warranty expense. This is something we have expensed on our income statement, but we have not done any of the warranty work yet. It's still on there as a warranty liability, never a contingent liability. So we need to add it to taxable income because we do not get to deduct it, which is going to increase our taxable income, which makes it a future deductible amount or a deferred tax asset. Okay, so now we've labeled and classified all of our temporary differences. We can go through, do the math on here, and we find out that our taxable income, $15,000, multiplied by the tax rate, which is given at 25%, gives us an income tax payable of $3,750. Okay, so we're going to plug that in here. Income tax payable, $3,750. I'm going to erase this part of it. Since this is the very first year, this is nothing reversing here. These are our amounts. Okay, so as I said, we can combine. So we have $77,000 in future taxable amounts, $12,000 in future deductible amounts. We multiply them all both by their tax rate. So that is step 2. That is our ending balance in our deferred tax liability from our future taxable amounts of $77,000 and our deferred tax assets from our future deductible amounts of $12,000. We have no beginning balances given, so we will put these into our journal entries. Deferred tax liability, 19,250. Deferred tax asset of $3,000. And final step is to plug income tax expense in order to make your journal entry balance. In this case, it comes out to $20,000. So this was one of your homework questions. Without it all written out, I just pulled out the important information and worked through it here. So when you get to that one, this one should be pretty simple to walk through. It's important to remember, combine the future taxable amounts and the future deductible amounts, but do not combine the two of those together. And as they start reversing themselves out in different patterns, you're going to go through the same steps. You just have to, as you did earlier, you just have to find the ending amounts of each one. When you get here, find out the dollar amount left as the temporary difference. Okay. So erase this. And the last other thing we need to talk about is net operating losses. And that is what it sounds, is if you have a company and you have a loss for the year. Now, of course, you're not going to have to pay any income taxes on that, but having a loss for a year does allow you to get some benefit on income taxes in the future. Now, up until the Tax Cuts and Job Act, the gap procedure and the law was that if you had losses, you were able to carry it back for 3 years and get some kind of refund on taxes you've already paid, and then carry forward up to 20 years to offset any taxes you might have to pay in the future. The new legislation pretty much eliminated the carryback option except for a few select industries, so we are not going to worry about that. We're only going to worry about the carry forward, which now you're allowed to carry forward indefinitely. Okay, so if you have a net operating loss throughout the year, you're just going to take that amount, multiply it by the tax rate, and that amount is going to become a deferred tax asset. It cannot be combined as we just did, the other temporary differences. This is a special difference all on its own, but it's a deferred tax asset, and it is specifically going to be there to offset the income tax payable in future years. Okay, and it is going to lower income tax expense when it is created, and then it'll be listed as an income tax benefit on the income statement. So we'll kind of run through all that real quick. So net operating loss, remember, so a company has $360,000 loss in year 1 and $200,000 profit in year 2. Okay, so here's our example with a tax rate as we've been doing of 25%. Sorry, that's something going on in my mouth. All right. So in the loss on year 1, we take the $360,000, we multiply it by the tax rate of 25%, and we get $90,000. Okay. That is going to be a deferred tax asset, and I'm going to note it as a net operating loss deferred tax asset of $90,000. As you can see, we have a credit here to our income tax expense. Okay, that is not normal to have a credit to an expense, but because of this, it is going to happen. When you look at your income statement, it's going to say income before taxes. But instead of income tax expense, you ever see a line called income tax benefit? That is because they had a net operating loss and they are getting a benefit for the year from that net operating loss. Okay. And then that is to get to your net income. So that's how you would present it on your income statement. I know one of your homework questions does ask that too. How would you present it? So just know that that is an income tax benefit. When you do the journal entry though, it still goes in as an income tax expense. Okay. So for our second year, we have a $200,000 profit multiplied by 25% means we need to pay $50,000 in our income tax payable. Okay, but instead of doing that, we will look at our GTA NOL. You see, it's got 90 in it. Oops, I don't know, I'm sorry. It's got 90 in it. So we'll have income tax expense, and instead of income taxes payable, what was that? We're going to take off 50,000, leaves us with 40,000 in there. Say in year 3 they had the same amount of profit, they have income tax expense 50,000. There's only 40,000 left in the NOL. The remaining 10,000 becomes payable. Okay. So this is not a real difficult process. It's just remember that you can only carry forward indefinitely. Could take some adjustments. Remember, if tax rates change, those same rules apply. This account will have to be adjusted for future enacted tax rates, but it does not combine with the other deferred tax assets. It is one all its own. But when it comes to the other temporary differences, you can combine them all together. All right. Those are the 3 videos for this class. I hope that's enough to get you through the chapter 19 homework that is now, or chapter 16 homework, I believe it is, that has now been assigned. As always, reach out to me if you have any questions. Good luck.